Okay, hi everyone. This is going to be the second lecture on Chapter 23 with regard to state and local income taxes. We're going to be picking it up here looking at state taxable income, right? So essentially, right, if we're talking about businesses, corporations, right, at the Fed, right, the federal level, they would file the 1120, but then they would also, for each state, right, potentially have essentially a state corporate tax return. Again, a corporate income tax return. So as I have here, right, businesses must calculate state taxable income for each state in which they file tax returns. They usually start with the Fed and they're going to reconcile to state, which is going to cause some adjustments, right? So this is the framework we're going to be tracking here. You can think of this kind of like, hey, this is the general way a state corporate income tax return works. Obviously, right, there's 50 states. We're not going to be able to look at all 50 states, but if we were to say like, hey, generally, how do these manifest? How do these work? Right, well, the idea is you start with the Fed, right, that 1120, you make some adjustments to kind of get it to the state tax base, right, because states don't use the same law exactly as the Fed. Some do, but some don't, right? There can be modifications we need to make. Once we get that state tax base, we're going to break it out between business income and non-business income. Essentially, the reason for which we're a business versus more passive income. We will apportion or divide the business income among the different states. And then the non-business income, those different types of passive income, we're going to assign each of those types of income or each kind of bucket there to a particular state, right? When we analyze it, the nuances of it given some particular rules. That will ultimately get us to our state taxable income. And once you get there, right, it runs just like a normal tax return, right? You multiply it by the tax rate, that gives you your liability, any credits, right, any sort of withholding, right? Either you're going to get a refund or owe. So from here down, it follows the traditional tax formula. To get to there, though, we have to start with the Fed, break it out, and then go from there. So it will make sense when we give some numbers to it, but right now I'm just giving you the high-level example. Right, so as a starting point, many states conform to federal tax law. In other words, right, they're going to just piggyback off of the 1120. Hey, you've already done all that 1120, right? We're going to, for some states, just say, hey, that will be the starting point that we go from whenever we start to get to our state tax base down here. Other states, right, are going to have like differences, right? Maybe they use a specific version of the Internal Revenue Code, right? So California there is as of like 2015, right? On top of these things, right, if we're going from the Fed to the state, right, we're going to have to make some AJEs, right, on there. And essentially these AJEs, these adjusting journal entries, some are negative, some are positive, and they really recognize the difference between, okay, you had this number on your federal return, maybe you included income, but on the state return, we're not going to include that income. Or you took a deduction on your federal return, but we're not going to let you get that deduction on the state return. Various sort of adjustments you can make, right? So if we look at this list, this is a good list here, right? So here are positive adjustments. Here are negative adjustments, right? So you're going to add these to federal taxable income, right? So state and local bond interest from other state bonds. If we go back here, right? So at a state level, right? How a muni bond is taxed depends on, as a general rule, the location and kind of the source of that muni bond, right? So on the Fed, right, you're going to put $0 of interest from a muni bond, right? If the state was New York, right, that would be like the return we're doing, the New York state corporate tax return. Say that muni bond, right, was a New York muni bond, right? If that was the case, New York would not tax it, right? In other words, states don't tax as a general rule their own muni bonds. However, say that it was, a PA muni bond, okay? Well, on the Fed, you report zero. They don't tax municipal bond interest. But if it was $100 or something, right, the interest at the state level, right, if it was a New York return, they're going to tax that PA bond, right? So that's what this means here, right? We're going to have to add essentially muni bond interest from other state bonds, right? We're going to add state and local income taxes paid, any federal dividends received deduction, federal income tax refunds where the federal tax is allowed as the deduction, any differences in depreciation, amortization, or depletion in excess of state law, expenses related to U.S. obligations, right? So all of these guys, big plus sign. Right over here, right, minus sign, right? We're going to back out any federal interest income on U.S. obligations, so like T-bills, notes, and bonds, a state level dividends received deduction, something known as a foreign dividend gross up, state income tax refunds included on the federal return, to the extent there's differences in depreciation that cause a subtraction. Again, you can look at this list. The idea is we're trying to go from state to Fed, right? So here's a good example. If we look at this, right, so we have Green Corporation, right? They're in state A. They have federal taxable income of $500,000. Contained in this amount, right, there are certain items, right? It says they also had, contained in this amount $10,000 of state A bond interest, $20,000 of state B bond interest income that was excluded on that federal return, right? So we have $500 here on the Fed, right? When we came up with that number, right, we did these things over here, right? Those things were included, and then we excluded some muni bond interest there, okay? Now we're trying to figure out, hey, what is our state A tax base, right? And what is our state B tax base? All right, essentially we're going from the Fed to the state, right? We're going to have some positive adjustments and some negative adjustments, right? So you can see, you can look at them just like a column. You can kind of run through there and look, okay, why are we doing each one, right? Well, muni bond interest outside of the state, right? Sometimes you have to add that back. In state income tax, right? You have to add that back. Any interest income from federal bonds, right? We're going to subtract out, right? States don't tax that. At the end of the day, right, our state tax base for state A is going to be 525, 515 for state B, okay? Oh, let me move this down, right? So we just did, right, this kind of box up here, okay? So you do that for each state on there. Then it says all state taxable income is taxed in the state of commercial domicile unless the business is taxable in more than one state. Whenever you have an interstate business, right, so they're operating in multiple states, we need to break out from that state tax base the business income, really the reason you're a business, from like your business operations, from non-business income, which tends to be like more passive income, like investments, things like that. Then we're going to apportion the business income and allocate the non-business income, right? So if we look at Green Corp, right, state A corporation, they have a state tax base of 525. That's great. We just saw that in the last example. It says of this amount, 200,000 derives from passive income, meaning Green Corporation has 325 of business income, right? So we got, if we were kind of running the numbers on this, right, we're at 525 right here. We said, hey, 325 of that is business income, which means 200 is non-business income, okay? Just kind of working our way down the chart here. Then what we have to do is, right, we have to apportion, right, that business income and allocate the non-business income. Basically, using for the apportionment a factor and allocate to a specific state each of the line items there for what's in there, right? So this 325, right, what we're going to do here is essentially we're going to look at, those states with which we have a nexus for it. We're going to basically figure out a percentage, right, of that we multiply it by for each state. So, hey, maybe 10% over here, 20% there, 70% here, right? The idea is we have to figure out some way for each state, right? So like West Virginia gives us a percentage, Pennsylvania gives us a percentage, and Ohio gives us a percentage, right? How we figure out this percentage, right? Each state has their own rule for it on there. And what they essentially look at when they create their percentage is basically like property, payroll, and sales. Right, some combination of this. They look at, hey, how much of these items do you have in West Virginia versus do you have everywhere else, right? That gets us a percentage. Interestingly, right, because each state has its own percentage, it's possible that it can add up to more than 100%, right? It might be like, okay, we use the percentage over here, we allocate 200 income, we use a percentage for PA, we allocate 100 income. Over here, they give us a percentage, we allocate 50 of income, right? Well, if you think about it, 200, 150, we're at 350 we had to pay tax on, but we only had 325 of business income. This is just kind of one of the things that could happen here. It also could act favorably, right? It is possible these percentages, maybe we totaled it up to 300 on there. So it's not always perfect in that way. So we'll talk about that setup there. With the non-business income, that $200, right? You could say things like, okay, that's item A, right? Maybe that's some dividends. We have item B, which are some capital gains, right? And we have item C, which, I don't know, let's just say like is rental income. The idea with these is instead of kind of pushing it out based on a percentage, we are going to basically look at each one of these, each instance we have of it, and assign it in that case, or allocate it to a particular state. Maybe just those dividends are going to go to West Virginia. Just those capital gains are going to go to PA, right? I mean, you have to look at this specifically, but we'll come to it. Right, so it says here, business income includes all revenues and expenses from the ordinary course of business. We apportion this, right? How we apportion it, right, is based on essentially here, as I had, right, I have property, payroll, sales, right, property, payroll, sales, right? We look at those factors in some combination. It's a little bit wonky because the percentage, right, this percentage here is based on like 3 other percentages, right? So it's like a little bit of math on top of math. So hang in there with me, right? We need to look at each of these percentages first, right? Figure out how we do those percentages to help us get the ultimate percentage we use to apportion it, right? So with regard to the sales factor, right, essentially we look at our total sales in the state, I don't know, maybe in West Virginia, right, over all our sales in all states, right? The sales factor there, it's going to include gross business receipts, net of returns, allowances, and discounts. There are some special rules for that, okay? I'm going to run through the examples in here, and then we're going to go back and kind of trace all of this out a second time in the Excel problem. So I think that's a good way to look at it. So when we're looking at, right, the sales factor, right, for quantifying the sales, there are some special rules here, right? So the sale of tangible personal property, right, that's going to be sourced to the destination state. In other words, where it ultimately lands. Hey, we sell something, we ship it to Pennsylvania. Whenever we figure out, like, the amount that goes in, Pennsylvania over all states, right, we're going to include in there stuff that was sent to or landed in Pennsylvania, right? However, if there's no income tax nexus in that state, you're going to throw it back to the sale of the state of shipment, right? So maybe, hey, we ship it from California to Pennsylvania, right? That's where it lands. It's going to go in the numerator for Pennsylvania, right? If we have income tax nexus there. If we don't, we throw it back to California. It'll go in the numerator of California when we do this. That's generally going to be property. How about the sale of services, right? Well, we're going to look to which state we perform those services in. Any government sales, right? You sell stuff to the government are going to be sourced to the state from which they were shipped, okay? So that's the sales factor. Again, we'll look at some examples. This is just kind of theoretical right now. Let me kind of move this down, right? So we just looked at how we get the sales factor, right? It's basically the numerator, your sales in that state, over your sales in all states. Payroll, similar thing. Your sales in that state, state X, I don't know, maybe we'll use PA if we were trying to figure it out for PA, over our payroll in all states. Now, again, we have some rules here to figure out, well, how much do we put in that numerator, right? We're going to include salaries, commissions, bonuses, and other forms of compensation. We do not include independent contractors, right? So if we're a West Virginia business and we have an independent contractor in PA and we're trying to sort of apportion our business income to PA, that would not be part of our payroll, that independent contractor. That would go in the numerator in PA. You don't include it there. It says payroll for each employee is apportioned to a single state, right? So if you have an employee who works in multiple states, right, you have to see where they do the majority of their work. You don't get to kind of bifurcate it. Okay, so there's payroll. It's essentially payroll in the state over payroll in all states. And then finally here we have property factors, right? So maybe it would be property in Ohio over property we have in all states, right? Generally, it's going to be all real and tangible personal, or real and tangible personal property. We do not include intangible property. Some more rules, right? So these kind of nuanced rules for the factors are fair game for testing, right? It would be just like super easy if I said to you like, oh, okay, here's the numerator, here's the sales in all states. Sometimes I'm going to give you some information and you need to figure out what specifically goes in the numerator. So for property, right, it's not like you just count the property. You have to use the average property value for the year, right? So beginning plus year end divided by 2, right? So average property using historical cost. Any property in transit, right, if it's in the mail, right, maybe we bought some tangible property, it's coming our way, we're going to include that and source it to the state of destination. We're going to include only business properties, so right, values properties the business owns but rents to others, so investment properties are excluded. And then we're going to include property the business rents or leases. We're going to multiply that times 8, right? So if you think about it, right, you don't really own property that the business rents, right, rents to use in their business. You don't own it, but it's still property. So we're going to multiply that times 8. However, if a business owns a building that it rents to someone else, namely investment property, we exclude it. Okay. So as I have here, right, each state, right, so we did property factor. Once we get these 3 percentages, right, then it says each state creates its own formula for how to apportion business income to the state. In other words, you don't just pick a factor, right? You don't just be like, oh, okay, we're going to just use the property percentage and multiply that times 325, right? Usually what each state does is have some kind of combination of those 3 factors, right? So maybe this was 10%, maybe this was 12%, maybe this was 5%. West Virginia down here, they say, hey, whenever you multiply the 325 of the state sales or of the business income, which comes from the state sales tax base or the state tax base, we're going to use some combination of 10, 12, and 5. It might be 10 plus 12 plus 5 divided by 3, the weighted average. It could be just one of the factors, right? We're going to just use 5% for the sales factor, right? There's various things they do here on there. So as I have here, right, for example, states can use an equally weighted payroll, a double weighted sales factor, right? So this is one approach they can take, a different approach they can take, or just a single sales factor approach. So let's look at this. Here is, and we're kind of building off of this, this is going to be the property factor, right? Just giving you an example here for the property factor. So it's beginning plus ending plus our rents from it that we pay, assuming income tax nexus. How are these property factors for state A and state B? Right, so for state A, let's just focus on state A. Right? If I said to you, okay, we're trying to figure out the property factor here for it, we know at a general rule it's going to be state A over all states, but there's some specific rules, right? The property has to be the average value of the property, right? So we're going to do beginning plus ending divided by 2. There we go, there's 150. Likewise, anything that we rent, right? We rent this $50,000, right? We have to multiply that times 8, right? So that'll give us $400,000, right? So that's going to be, our total property of $550, right? If we do the same thing for B, we're at $350, but then, you add them together, you're at $900, right? So if it's essentially, it's going to be, state A over all states, right? It's going to be the 550 over here divided by the 900 for all states. Hey, there is 61%, right? So that would be like we put 61% right there. And we were just talking about as you kind of get the 3 factors, right? 10, 12, and 5 up there, right? How we kind of mix them together, 10, 12, and 5, right? How each state, looks at it, they use different things, right? Some of them are just like, hey, we're going to use an equally weighted 3 factor, right? We value these equally. So it would be, what's our sales factor here? 5. What's our payroll factor? 12. And 10 divided by 3, right? That gives us sort of a new percentage that we would use down here. Some states are like, look, we want a double weighted sales factor, right? So it's 5 plus 5, right? It's double weighted. Payroll factor 12, property factor 10, divided by 4 because, hey, there's 4 factors there. Other states are like, look, we just want to use the sales factor, right? 5% on there. So here's a good example on this. right? So say that we ran through the numbers on this, right? We said, okay, we have a business, Red Corporation, they're a state A corporation. They have a $10 million state tax base, right? Of that amount, 7.5 is going to be business income, and 2.5 is non-business income, okay? Now we're trying to say, hey, how do we, of this 7.5, allocate it to state B, state C, right, state D, right, state A, right, a portion there of that amount. Well, we said, hey, we got to figure out for each state, right, the property factor, the payroll factor, and basically the sales factor, right? So here what we do, right, so if we were to just focus on state A, right, for each of these, to get the property factor, no, let's focus on state B, right? If we were focusing on state B, right, to get the property factor, it would be 100 divided by a million, right, 10%. To get the payroll factor, it would be 150 divided by 3 million, 5%. To get the sales factor, right, it would be 200 divided by 5 million, 4%. Right, so we have property 10%, payroll 5%, 4% sales factor, right? Now it says, right, we're trying to figure out how much goes to state B of that 7.5. It says here state B, we're trying to apportion their share of business income. How do you deal with this if it uses an equally weighted three factor, a double weighted, and a single weighted? Right, well, if it's equally weighted, right, we're going to do essentially, let me highlight this right here. We have 10, 5, and 4. Right, we're going to do the 10, 5, and 4 divided by 3 in there, right? That's going to give us percentage. We multiply it times the 7.5 right there times the new percentage. Hey, we would allocate 475,000 of that 7.5 million. Similar setup here for double weighted sales factor, right? So it's it's going to be 8% there, 4 plus 4. Again, here we divide it by 4, and if it's sales factor, hey, it's just 4% that goes there. Okay. How about next, right? So we've kind of looked here. We go to the left, right? We have the business income. What do we do when we go to the right when we have that non-business income? Well, essentially here, right, we have to allocate or assign this to a particular state. There's going to be rules for each of these, right? We're going to allocate interest and dividends to the state where we're domiciled, right? So, hey, this is passive income, interest and dividends. Wherever we're domiciled, that's where we're sending that to. Rental income, we're going to send that to the state wherever the property, right, the rental property is. Royalties to the state where the property is used on there. Capital gains from investment property. Hey, we sell like our investment property to the state of domicile. Capital gains from selling rental property to the state where the rental property is located. Okay, so let's look at an example here. This is a good, I like this thing here because it's simple, right? We have 10 state tax base. We said 7.5 is business income, right? We talked about how we kind of push that out using the different percentages. 2.5 is non-business income, right? That's where we get the 2.5. What we have to do is right, essentially assign this to a particular state, right? So of the 2.5, we know it's passive income. It's 2 million in rental that's located in state B, 300,000 of dividend income, $200,000 of interest income. What do we put here to state A and state B, right? Well, state A, right, we're going to say they get 300,000 of it, right? The dividend income and the interest income. That's because that's where they're domiciled, right? It's a state A corporation. If we go back here, it says, hey, interest and dividends, whenever you're kind of sending that down the path where to assign it, send it to the state where you're domiciled, right? So, hey, we're domiciled in state A. Here, right, the rental income, we're going to send to state B, right? 2 million of rental income because the real property generating the rental income is allocated in state B, right? That's this guy. Oh, no, right here, rental income, just pure rental income, not from the sale, wherever the property is located, right? So that's kind of showing. And then it says, assume it wants to purchase a new rental property. There's some tax strategy on there. After you kind of, figure that out, right, you work your way through there, right, you get to your state taxable income, which is essentially going to be, right, like it would be like your West Virginia, the $200 there, plus the West Virginia over here, maybe those dividends on there. Then you multiply times the state tax rate, which gives you the liability. You back out the credits, which gives you the refund or the taxes owed on there. So that's, kind of showing that. We'll look at the examples. The last thing is be aware here of non-income based taxes. So some states are kind of starting to do this. So it's like Washington, Texas. There's a gross receipts, a margin tax. The idea with this is they're trying to increase taxes from non-domiciliary businesses, right? It's kind of a workaround for 86-272 because that only applies to income-based taxes. So if we were to just look here to kind of wrap this up and another example in the book, I think these are good, another way to look at it. Right, so here, what are we doing? Right, we're going, our starting point, if we were to just focus on Idaho, right, we start with Fed income of 53,000. We add some stuff, we back out some stuff, some adjustments, right? That gets us to our state tax base for Idaho. Check, right? We can if I can erase all of this. Actually, here's what I want to do. Right, so I'm just going to put a check mark there, showing you from Excel, right, what we're doing. Federal to state, make the adjustments, check. We're just going to focus on Idaho. Of the amount we put in Idaho, right, $97,000, right, the 97, right, we're saying essentially 59 is business income, and whatever the other amount is, right, that's going to be our non-business income, right, so the 38. That's what this guy is showing here, right? Of the 97 we put in Idaho, 38 is non-business income, which means 59 must be the business income. Right, so business, non-business, kind of active versus passive. All right, we know, right, what we're going to focus on next is how we kind of dish this out, this business income, right, the 59 on there. We have to figure out our factors, right? So we need to figure out our sales factor, right, for Idaho, 31%, right? Idaho sales over total sales. So let me put, just a kind of check mark here for business income. We're looking at Idaho. We got to figure out our sales factor, our property factor, and our payroll factor. So we just figured out our sales factor, check. We look over here, right, our payroll factor, 27%, check. No, that's property. Payroll. Then we figure out our property factor, right? Check. Look at this, right? This is a good, amount showing you that, right? It's the average value for the property, and anything that we're renting, we have to multiply it times 8, right? So that's kind of the setup there whenever we get that amount. Okay, we figured out those 3 things. Now it says, okay, assume they use a double weighted sales factor, right? Or assume they use an equally weighted sales factor. We'll just focus on this one, right? So what we're now gonna do is, it's a double weighted sales factor. Let me go back and see what that number was here. It's 59, right? We had 59 of business income. What we're gonna do is, whenever we're allocating it to Idaho, make this bigger. Right, we're gonna use, sorry, let me go back here. Double weighted sales, so this will be the percentage we ultimately use is sales plus property plus payroll divided by 4. Right, so you use those guys to get a percentage for Idaho there. With regard to the non-business income, right, essentially we have to look at each piece of that and follow the rules, right? So here, Idaho, right, it looks like we need to allocate those specific amounts. So put the check mark over here. Right? So we've kind of done business, we've done non-business income, what we allocate to Idaho. We then would, right, go from here, right? Here's kind of a good starting point. Our state tax base, we break that out between business income and non-business income. We apportion the business income to Idaho based on the factor. We allocate the non-business income, right? This amount right here is essentially like this guy right here. That gives us, you add them together, 43,988, right? So our state taxable income right here is 43,988, and then we just follow the normal state tax formula on it. So, a little bit tricky, a little bit hard there. What I would say, like where you could screw this up, is probably not knowing those specific rules when you're calculating the property factor, the payroll factor, and the sales factor. So I would say look at those. Nothing in itself is that hard, but it's just kind of a collection of information. So I'm going to end the lecture here on this one.